Welcome to the second week of Money and Banking. We're still in the basic definitions part of the course, and today we'll cover the issue of money, a slightly different essence from financial assets. A good chunk of this should be a review from your introductory macro classes, and the relevant reading can be found in Mishkin Chapter 3. Since there's still no economic models I'll present at this point, this week, like last week, has no practice problems, but only a weekly assignment at the end of it. Now, money, of course, is a term we use all the time, and colloquially it has three separate uses. The first one is cash, or coins and paper money, that is banknotes. We also refer to cash as currency. For instance, if someone asks you to hand over your lunch money at the schoolyard, what they want is the cash you have on you. They don't want your debit card, they don't want your bank account, and so forth. The second common use is money is wealth. For instance, when we say Jeff Bezos has a lot of money, we mean really to say that he's wealthy. Finally, we also use money to describe a person's income. For instance, when working in investment banking, you will likely have an early stroke, but you'll also make lots of money, which means that the job provides a good income. Now, when economists refer to money, they strictly mean something else, namely the means of payment, defined as anything that is generally accepted in the exchange of goods and services and in the repayment of debt. The important word here is general. You might be able to trade your ceramic figurines against something else with another person, but a corner store will generally not accept it. Notice that governments make officially appointed government money legal tender, which means that money like the US dollar has to be accepted to pay for your tax bill, and it has to be accepted in the settlement of courses. Outside of that, you're of course free to accept a dollar bill or otherwise leave it be. Now, how does this formal definition measure up with the colloquial use of money introduced earlier? Cash, like coins and banknotes, are generally considered money since you can use those to pay pretty much anywhere. However, there are other forms of money, like your debit card, that are not cash. And in this sense, cash is too narrow a definition to count as all of money. In a similar vein, a wealthy person likely has a lot of money, i.e. cash in their pockets and some in their checking accounts, but much of Jeff Bezos' wealth, for instance, like his helicopter and expensive fleet jackets, are not money he could use to pay for stuff with. Finally, at least some of your income is paid in money, that is your paycheck. However, income is different from money for two reasons. First, income is a so-called flow variable. That means it is accumulated over a period of time. Your annual income measures what you have earned over the course of a year, for instance. Money, meanwhile, is a stock variable, meaning there's a fixed amount of money you own in your wallet or your checking account at any given point in time. The second distinction is that part of your income may include non-monetary benefits, like for instance healthcare, fringe benefits, and so forth. Now you may remember that money has three functions: the medium of exchange, the unit of account, and the store of value. Only the first function is truly unique to money. It is what makes money money. Meanwhile, the third function, store of value, is a function that financial assets especially have as well, which is why we discuss money in the context of financial systems in the first place. As we will see, money is a substitute for financial asset when it comes to saving. Now, before we get there, let's quickly talk about each function of money in detail. Medium of exchange, as mentioned, is the definition of money. It simply indicates that we pay in most transactions using money. The alternative would be a barter system, which is a system in which all goods and services are exchanged directly. Barter systems are hugely inefficient since they require a so-called dual coincidence of wants, meaning that both parties in a transaction need to offer exactly what the other party desires. Since this is rare in a highly diversified economy, barter complicates trade and creates high transactions cost. Transactions cost is a term that will appear a number of times throughout the course, and it indicates the cost involved of a transaction that is not part of the price of a good or service itself. For instance, when you buy a piano, there's a price tag on the piano, and the shipping cost of the piano are transaction costs involved in this particular exchange. Now, in a barter system, time spent searching for a suitable exchange is what creates dramatic transactions cost. If I, for instance, wish to buy a beer from a vendor, I might be out of luck. All I personally have to offer economics lessons, and the vendor likely won't be interested in that. So first I'd have to chase down someone who'd be interested in economics class from me, who could exchange that for something that the vendor wants, say for instance a cow, which then I could exchange for beer. Needless to say that gets complicated quickly, especially in an economy that offers many services and it offers many goods. Since barter is such a hassle, most economic transactions are thus indirect, using a common exchange good, which is by definition money. It's the medium of exchange. Reducing transaction cost is the most significant benefit of money, and a good that is a suitable type of money needs to have certain qualities to be functional. For one, it needs to be easily standardized. That means every piece of money needs to be exactly the same to be usable. It must be accepted widely, otherwise it's not money. It must be divisible, since the value of goods and services varies greatly with an economy. It must be portable, so you can take it to store, and it cannot deteriorate in value too quickly. That is why, for instance, diamonds, which are not divisible, or tuna sandwiches which don't last very long, are bad goods to be used as money. The second function of money is unit of account, meaning that we most typically price things in money. It is the most common measure of economic value. Now, you may recall from micro that economists in theory think in terms of relative prices. That means in exchange rates between two specific goods. For instance, we know that an avocado is worth about 3 or 4 bananas depending on the day, or that a mid-price car is the value of several thousands of bananas, and so forth. While this of course reflects reality in some sense, it's not practical to express the price of one good in terms of the prices of all possible other goods on a price sticker. Instead, we reference most prices to a single good, the so-called numeraire good. And in practice, we use money for this. So when you go to the store, what you'll see there is some money value on each thing you could buy. But it seems like an important function. There really is no reason why prices need to be expressed in money. We could use literally any other good for it. For instance, we could use apples. No reason why we cannot price a car in the number of apples it would take to buy one, or a college degree. Any single good could really work for this as a numeraire, and none would affect the underlying relative price structure in a fundamental way. The only reason why we use money as a convention is because we already use it as the medium of exchange. It's simply a convenient thing to do, but it's not necessary. Since the unit of account is not economically all that interesting of a function, I will not discuss it much in the further throughout the course. The third function of money, meanwhile, is important in the context of financial markets. To be functional, as mentioned earlier, money needs to be able to keep some value over time. Consequently, we can use it to save, that is, to store value. Now, recall that households use the disposable income to either consume or save. Saving in this context then only serves to postpone consumption at a future point. If your current income exceeds what you currently wish to spend, you can put some aside to consume it at a later point. Now, there are many available goods like bonds or stocks, houses, or even consumption goods that you could use to store some of this income and to consume later. Money is merely one of many available substitutes in this context. It's important to point out here too that money is by no means the best savings mechanism. Bonds, for instance, pay interest. Stocks, for instance, appreciate over time. If you buy a house, you can live in the house, which provides you with housing services. You don't have to pay rent. Money only has a single rate of return, which is the inflation rate. And typically, with inflation positive, that means that money loses purchasing power over time. So the question is, why would anyone use money to save? Why would you ever keep money in your checking account? The short answer to that is that money is liquid. That is, it can be immediately used to pay for things. For instance, your stock portfolio might be better in terms of rate of return, but if you want to buy something, you cannot use stocks. You'd first have to sell them, transform them into money, and then you can go pay things. Now, liquidity generally indicates how easily an asset can be transformed into the means of payment. Liquidity is a desirable thing for households because we live in an uncertain world. What this means is that we don't exactly know when we have to make expenses. A bill could arrive one day that you didn't expect. You might injure yourself and have to do surgery, and you have to be able to pay for that. For that, it is useful to have some liquid asset around, and money, of course, is the most liquid asset by definition. Now, finally, is money a good store of value? The answer is typically it's all right. Under normal inflation rates, say 1 to 2 to 4 to maybe 6%, a dollar is almost worth exactly $1 a year from now. That's not bad. It's certainly not creating a strong pressure for you to get rid of your dollar the moment you earn it. However, during high inflation, and especially hyperinflation, that is inflation rates of more than 50% a year, money becomes a bad store of value. The other scenario, which we will discuss at a later point, is deflation. In this scenario, money becomes an extraordinarily good store of value. It gains value over time. However, deflation is generally a sign that other things in the economy are amiss.